September 2nd, had a little bit of a market crash today, but no biggie. Made a little bit of money along the way, and I wanted to provide a market update slash account update. Today, we got some rising bond yields, and also I think the market was a little shaky in anticipation of big economic reports coming up soon. With all of that noise going on in the background, I wanted to take advantage of the dip and share those trades with you. The first thing we can talk about is my wheel trade going on with SOXL. I planned on adding my third leg. So just to recap on the SOXL wheel strategy is I'm laddering them out. I'm starting 4 calendars away, about a month. I'm selling a put, then I'm waiting a week, selling another put, waiting another week, selling another put, and then I'm going to cycle through these puts. The one on the bottom here expiring on September 26th, I sold today and it's already up quite a bit. I went ahead and added it today because the market was crashing and I got better implied volatility when I sold the put and figured I'd just take full advantage of that higher implied volatility. So now that we've covered SOXL, there was a few other trades I did today. And the other being that I added ULTY to the mix for my high distribution ETFs. I went ahead and added it today because, like I said, market's crashing. Why not get a discount? And I'll get into more details about why I made that purchase later in the video. Then lastly, I sold a put spread in SPY and the 0 DTE, and I also flipped some shares of SPLG. So let's go to the transactions. For September 2nd, you can see the date here on the left. I went ahead and bought SPLG. I was looking at the RSI and the Bollinger Bands, and I'd been watching the market dip all morning, and I figured why not buy 5 shares. I'm dabbling with doing shorter term trades. So I did not want to make a large investment. I started with 5 shares just to kind of dip my toe in. I'll probably keep doing this just to get used to it and see how profitable it could be. Today, I only made $1 on 5 shares. So the plan was I was willing to allocate 10 shares, meaning I'm willing to buy 10 shares. So I started my first leg in with 5. And if it continued to go down, I would start buying a share at a time to lower my cost basis. And then I had a profit target of 20 cents a share, which is $1. And that's pretty much what happened. I waited for it to hit the bottom of the Bollinger Band. It hit it. I purchased the 5 shares as it was riding up. I put in my limit order to buy it back. There you go. There's $1. $1 is not very impressive, but it is scalable. So if I bought 500 shares instead of 5 shares, I would have made $100 instead of $1 today. So that's the idea I'm going for. I'm not really going for big home runs. I'm just experimenting with smaller investments. And plus, this account isn't really set up for this additional strategy, so I did not want to allocate a large amount of funds to this. I basically used the profits that I've accumulated over the last 3 weeks. So that was my rationale for the SPL trade. So I bought it for $74.75 and I bought it back for 74.96. So some things I like about doing this is that it's a lot safer and easier and simpler than doing the 0 DTE SPY put spread. That being said, if the market continued to crash and had bought all 10 shares and it just kept going down, 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 what's the big deal of owning 10 shares SPLG? It's not going to hurt me in any way. If my account was set up and I allocated the funds to buy 500 shares or 1,000 shares, as long as I know that going in and I have the capital, it wouldn't be the end of the world to own 1,000 shares of SPLG. In that regard, it's a safer trade, in my opinion. The worst case scenario is that you own the shares and you turn into a long-term holder of SPLG. That's my rationale with that. With the put spread, I also made a few bucks. I made $6 after commissions and fees. I was in the trade, not very, maybe like 20 minutes, 30 minutes, not super long. Only did a one lot. Again, I'm not looking to make huge amounts of money. I didn't know what the market was going to do. It could have kept going down for all I knew. That's why I just did small trades. So I did a 3 point wide 0 DTE SPY put spread. So I shorted the 635, collected $24 in premium, and then I bought the 632 for 4 cents. So altogether I had 20 cents and then bought it back at 11 cents. After the commissions and fees, it came out to about $6 profit. Again, super scalable. I'm only risking $300. So if I would have risked $30,000, I would have made $600 today instead of $6. So all of this is super scalable. It's easy to scale, but I'm still experimenting. We talked about the ULTY. I bought 100 shares today as it was dipping, and I went ahead and sold that SOXL 22 put and collected $134. So these are still my bread and butter trades, the wheel trade, the SPX wide put spread, and the high distribution ETFs. This 0 DTE put spread and flipping these few shares of SPLG is more of something I'm experimenting with on the side. So I wanted to share my Google Sheets just to provide a little bit better visual representation of the trades that I completed today. So going back to SPLG, I purchased the 5 shares for 74.76. I rounded up. I believe it was 74.75.5. Went ahead and just rounded up. My risk on this trade is $373.80. And I ended up selling those shares at 74.96, pocketed at $1. With the SPY, it was a 0 DTE put spread. I was short the 635. I was long the 632. At this point, it was about $2 below. So the market was trading around the 637 mark. So I was $2 below. I have that baked in safety there of $2. It was about 20 delta. Collected 20 bucks. I got the commissions and fees deducted out of that. So that was $17.36. I go ahead and do the round trip fee. So I'm taking out fees when I sold the put spread, and then I'm also taking out fees for buying it back. You could save a little bit of money on fees if you let it expire, but I don't like the expiration risk. So I go ahead and manage my put spreads, but you can do what you like. Bought it back for 11 bucks. And so that was $6.36. To sum these trades up, I made $7.36 on $674 of risk. That comes out to be about 1% in one day. That's what I find attractive about these strategies, and that's why I'm willing to risk a little bit of capital just to kind of get my feel of how it would work if I wanted to scale up. I pay attention to the percentages because once I've gotten a good idea of how things are going to be structured, far easier just to scale up. You're just multiplying by whatever. 1% in one trading day would be 5% a week. And 5% a week times 52 weeks a year is well over 200%, 280%. That could be very profitable. And that's why I'm willing to put a little bit of money in to kind of do the research behind that. I've already mentioned these trades in the past, but again, these are my bread and butter trades. I'm not looking to pay the bills with these small trades. This is just more of an experimentation. These are my core positions. And they've already produced close to $500 in profit. And I've only started this on the 20th of August. So it's only been 13 days. Today's day 13, counting weekends. Pretty happy with the returns. What is ULTY? It's a YieldMax product that is actively managed, and its primary mission is to generate income. It's not so great at growing with the market, but it does do a great job at generating income. And it uses option strategies to accomplish. So some benefits of ULTY is its weekly distributions and it's trading on high IV products and it's actively managed. So I could do these option strategies myself. I could take the time and allocate tens of thousands, hundreds of thousands of dollars to go after each of these high implied volatility products. The way I see ULTY as a low barrier entry to gain access to these high IV products that I wouldn't have the capital to trade all of these, if that makes sense. And it's actively managed, so I don't have to sit and stare at a screen all day because high IV products move very quickly, and that frees me up to do the things I need to do. My strategies, although they do require my attention, not as much. My SPX put spread is 10% below the market. Today's dip didn't worry me at all. And with the wheel trade, the dip didn't bother me at all either because I'm ready to take assignment of those puts. I have the capital allocated to buy the shares. If it happens, it happens. I'm not worried about that either. And then my high distribution ETFs, again, I'm not using leverage, I'm not using margin, I'm not worried about dips in price. If anything, that creates opportunities for me to buy ULTY at a nice discount. So some cons. It has a high expense ratio. The NAV erosion's been pretty heavy. I believe it was around $20 a share when it first came out. It's now trading in the $5 to $6 range. It's trading options on high IV products. There is a risk there with that higher volatility. Lastly, it's a newer fund with limited history. It hasn't been around very long, so another reason why I'm making a small purchase today. So in conclusion about Alti, I'm using my principles of buying in small. I'm looking forward to the income it's going to generate. I'm not super worried about the NAV erosion. I'm not a financial advisor. Please do your own research. Take care and God bless.